Now, back to the accounting equation, we said that where the resource being provided by both the owner and outsiders, then we will have what? Capital plus what? Liability being equal to asset. But in this case, we have moved a bit further to say that in terms of capital, where we have used the capital for a quite long period of time, then there should be some changes in the initial capital used at the business. And that will introduce what we call what? The equity. So equity plus liability should give us what? The asset. Right? Should give us the asset. So that is what accounting equation is all about. So that means that when it comes to the accounting equation, we expect that the equity and the liability should be equated to what? The asset. If you remember, we said that at any time resources are provided in the business, are supplied in the business, it's going to be used and run by what? The business through the management, business entity concept. So in that state, that means that here, any resource that will provide the business is going to be used by the business, From the owners, going to be used by the business. That's why that any resource that we provide, we expect is supposed to form part of the assets of the business. So if our equity was, let's say, $10,000, right, and our liability from the outsiders who have also invested is, let's say, $5,000, then we can say that our asset is going to what? We can say that our asset should be equal to 10,000, okay, plus what? 5,000. Plus 5,000. That should give us what? 15,000. So you can clearly see that on both left and on right, we are getting the same amount as what? $15,000. This is what accounting equation is all about. So I can give you an example. Now back to our example that we have here. In KK Business Limited, the capital at start was 5,000. As the business grew in size, they contracted a loan of 2,000 to support the business. Now the question is, what is the total assets of the business? What is the total assets of the business? So we'll say that here, with respect to our solution, we will say that here, we can clearly see that our capital at start was what? 5,000. So we have capital. Capital being equal to what? $5,000. And that of what? Our liability, or loan is what? A liability. Loan is a liability. We just mentioned that. Liability. So liability is also equal to what? $2,000. So with respect to the accounting equation, we said that when it comes to the accounting equation, where resources are being provided by two parties, then we say that we have our capital plus what? Liability being equal to the asset. So what is happening here? Our capital was what? 5,000. Okay. Our liability was what? 2,000. Okay. And that should give us what? An asset. So what do we get? In summary, we are going to get what? $7,000. So that means all the assets that we have in the business, what? $7,000. So at any time you are given any of these elements, all that you need to do is to make change of subject to find what? The other. All right. So that is the idea about the accounting equation that we need to what? Understand generally there. So once we have gotten that principle right, then let's take our discussion further. When it comes to recording of business transactions, there are effects that we experience with respect to these elements that are pivotal in accounting equation. So we are going to discuss the effect of the accounting equation, the effect of business transaction on the accounting equation, the effect of business transaction on the accounting equation. So let's see how that goes. Effect of business transaction on the accounting equation. So we're talking about effect. So effect of transactions, business transactions on the accounting or equation. How is that go? When you say transactions or business transactions are transactions that result in the exchange of goods with respect to what? Value, which is what? Money. Because you said that when it comes to recording of transactions, every transaction should be recorded in the books of account with respect to accounting purposes, is supposed to have a monetary value. So all business transactions we're going to record is supposed to have what? A monetary value. Without that, we can't record this as part of what? The account that we're supposed to produce to be used to prepare the financial statement. So now, the whole idea about the effect of business transactions on the accounting equation has to do with, okay, should in case there is a supply of a resource in the business or an asset in the business, what is the effect of that resource or that asset to the general asset that we have? Should in case we pay any debt as part of the debt that we were owing in previous period, what is the effect of that debt payment on the resource that we use in the business? Should in case we purchase or we buy any item using the resource of the business, what is the effect of that purchasing item on the overall resource of the business? That is what we refer to as the effect of business transaction on the accounting equation. So here we are going to discuss the effect that will occur on our resources should in case there are changes in the resource that we use in the business. And we said the resource used in the business is what we refer to as an asset, which is a combination of what? The equity, which is the initial capital plus or minus profit, and what? Liabilities that's been contracted by the outside, by the business. So for instance, our general equation is going to be in this form. We will have what? Equity plus what? Liability being equal to what? The asset. So we'll be given a transaction. Let's say bought, for example, transaction 1. Bought a motor vehicle. Bought a motor vehicle worth what? $2,000. Bought motor vehicle, $2,000. All that we need to ask ourselves is that, looking at this, we bought a motor vehicle worth $2,000. Looking at this, what are the elements that are being affected here with respect to the accounting equation? Remember, motor vehicle is what? An asset. But what type of asset the motor vehicle is? What? A fixed asset. A fixed asset or the non-current asset. What do we use to buy the motor vehicle? We use money, right? Cash. Or it can be cash or it can be what? A check. So that means the bought aspect here, which is the $2,000 here, it can be what? Cash or what? Check. So that means that here there is an effect on the resource that we use to run the business. Cash is affected. So shall fixed assets also affected. So what is it? So in respect to effect, we are also going to talk about in terms of its increase and what? Decrease. In terms of its increase and what? Decrease. So now we bought a motor vehicle worth $2,000. What is the effect of that motor vehicle on fixed assets or the non-current assets and that of what? The cash or check. So that means that here we will say that we'll have cash and we'll have what? Like say the non-current assets or the asset, generally the assets. Remember that motor vehicle and cash are all part of the asset. If you remember, we were discussing the types of assets or the forms of asset. We did mention of the current asset, the non-current asset. Under the current asset, we said that cash is part of what? A current asset. And under the non-current asset, we did mention of what? PPE, property, plant, and equipment. Motor vehicle can be what? A property. Can be what? A property. So it's part of it. So here, what is the effect on these two? So that means that this transaction is affecting what? The asset groups that we have here. So that means here, we bought a motor vehicle with what? Cash worth what? $2,000. That means our cash is what? Decreasing, it's reducing. Because cash of $2,000 has what? Gone out through the purchasing that we bought, engaged with the motor vehicle. So that means there is a decrease. There is a decrease in cash by what? $2,000 dollars. And there is also an increase in our fixed asset by what? $2,000 dollars. This is how we analyze the effect of the transaction on the accounting equation. So that means that here, the idea here is that since we bought a motor vehicle with what? Cash, what will be the effect on the accounting equation? What will be the effect on the accounting equation? Remember, before we get in this amount, somebody, being the owner, invested a particular amount. Let's say the cash that we used to start the business, or the capital you started the business was 10,000. So capital at start, capital was what? 10,000. 10,000. And now we have used what? 2,000 to buy what? A motor vehicle. What is happening here? So that means that here we are going to have what? Our capital. We're going to have our capital, okay? We're going to have our capital being equal to, what is happening here? Being equal to, so let's produce the, so we have what? Capital plus what? Let's say liability being equal to what? The asset. At the beginning we said that since we started with what? A capital of 10,000, it means that here, our capital is going to be equal to what? The asset. Our capital is going to be the asset. What we have here as what? 10,000. And we have here as what? 10,000. 10,000. All right? And now, we have bought a new motor vehicle with what? Cash worth what? 10,000. So here, that means that the capital side, which was cash that we started the business, this is how it's going to be. We can say that C can be broken down into, so asset part here, we're going to have for cash here, okay, plus, let's say, motor vehicle. Motor vehicle. Because the asset consists of what? It was, at first, it was just cash, because we started with the business with a capital of 10,000, which we use by the business here is going to refer to as cash of the business. And now we due $2,000 to purchase for the motor vehicle for the business. So what is happening here is that we're still going to have our capital of 10,000 here, okay? Then our cash value, which is 10,000 in this case, which is an asset, would now drop to become what? 8,000. Because we have spent what? We have spent 2,000 to buy a motor vehicle. Then we'll have plus the value of the motor vehicle, which is what? 2,000. So we'll have that one also here. And at the end of the day, so the accounting equation will agree. So just that here, our cash was being decreased by what? 2,000. This is a current asset, was decreased by 2,000. And then our non-current assets, which is what? Motor vehicle, has been increased by what? 2,000. So that is the idea here when it comes to what? The effect of transaction on the accounting equation. It is as a result of decrease and then what? Increase. So let's take note of that. What about this? Example 2. Paid rent. Paid rent. Paid rent. We paid rent. Worth $500 by cash. Worth $500 by cash. Paid rent worth $500 by what? Cash. How do we go when it comes to the accounting equation? So, paid rent worth $5,000 by what? Cash. Now, using this that we have built here, just follow it, that we have built here, we know that our capital at the start is equal to what? 8. So now we have what? Capital plus, so this one is just capital. So we have what? Capital being equal to what? The asset. Right? Now we have the asset breakdown to be equal to, so capital being equal to cash. Cash plus what? The motor what? Vehicle here. And now we have paid what? Rent. We have paid what? Rent. Worth $5,000 by what? Cash. So what is the effect on this on the accounting equation? Pretty simple. Since we have paid what? Rent by cash of 500, we know that this is a balance that existed in our assets book. Capital being equal to what? 8,000 plus 2,000 is the motor vehicle. Now that we have paid for rent, we will have here as 10,000. Okay? Then our cash value will then what? Reduce by what? 500. Our cash value will then reduce by 500. So if it's reduced by 500, what do we have? We have here 8,000. reduce it by 500, what do we get? The difference is going to be what? 7,500. 7,500. So here, the cash amount will be reduced by what? 500. And we're going to have what? 7,500. Then we will have what? The motor vehicle still there, which is what? 2,000 here. 2,000 here that we're supposed to have. But where is the amount that we pay? We have paid for rent. Rent is also, let's now assume that the rent that we paid for, we haven't used the space. It is part of what we call prepaid what? Expense. All prepaid expense is also part of what? The assets. If you remember, the non-current assets part, we discussed that prepaid what? Expenses. Right? So assume that we haven't used the space and we have rented it, it's also part of the asset. And that should also be supposed to be included. So prepaid what? Expenses. Prepaid expenses. So you're going to have that also coming up as part of the asset, having what? 2. That was what? 500. And yet the accounting equation will agree. So you're going to have here 10,000. Let's check. Should be equal to 7,500 plus 500. What do we get? We get 8,000 plus 2,000. We get what? 10,000. So that is that. So this is how we analyze the effect of what? The transaction in on the accounting equation with respect to the books of what? The account. Here's how it goes. So as always, there's going to be a changes in the elements, capital assets and then liabilities, or equity capital and then liability. So these are how we analyze the business transaction when it comes to the accounting what? Equation. So haven't we gotten the knowledge in here? We just want to extend it further to look out for, okay, so now that we know that we have equity plus what? Liability being equal to assets, then what is the combination or which items comes together to form the equity, liability, and then the asset? Now we are trying to expand this word, lesson, so that we get to understand what is happening here. We said earlier in our earlier part of the discussion that equity is a combination of what? Capital plus profit or what? Loss. Capital plus profit or what? Loss. So that means that if that is the case, then we can replace the equity by what? Debt. So now let's assume the profit side of what? The idea we want to build up here as the business. Let's assume the profit part of it, because every business seeks to make profit. So there is no intention of making a loss. If you want to make a loss, that's your own business. You take care of that. But here, we want to make a profit. So that means we can replace what? The equity by what? Capital plus profit. So we can say that we have capital plus profit plus liability being equal to what? An asset. Now follow carefully. We are building something up here. Capital plus profit plus liability being equal to what? An asset. But somebody may ask, how do we measure profit in just a small business environment? How do you measure profit in just a small business environment? So in profit ascertainment, in extracting profit, we say that profit is measured. This is how we measure profit. Profit should be equal to, we consider the total amount of sales you have made for the period. We also consider the cost we've incurred in achieving the sale. So profit is going to be what? Our total revenue, our total sales, okay, compared with what? Our total cost. Or we can refer to that as what? Expenses. Expenses. So when we deduct all our expenses, amount incurred in running the business from the revenue that we generated from the business, that should give us the profit. So at this point, we expect that our revenue should be greater than what? Our expenses. And that should give us what? The profit. So this is how we also measure profits. So that should tell us that here, we can also substitute, right? In terms of the profit here, we can also replace it by what? Revenue minus expenses. Revenue minus expenses. We can do that. So this is what we can do. So we can say that here, we will have what? Our capital plus the profit part. We can replace it with what? Revenue minus expense. So we'll have what? Plus R minus E. Let's say EX being an expense, okay? Then plus what? Our liability, which is what? The L here, should be equal to the assets of the business. So once we have this, then let's rearrange it better. We can see that in rearranging this, we will have what? Our capital plus our revenue plus our liability being equal to the asset plus what? The expenses. Plus the expenses. And this is what we call the expanded form of what? The accounting equation. The expanded form of the accounting equation. Now let's continue with the discussion. This same equation that we have expanded can also be written as what? Because this is an equation, so we can also write it as what? Asset plus what? Expenses. Asset plus expenses being equal to what? The capital plus revenue plus what? Liability. Capital plus revenue plus liability. Now look at the magic here. I want to have a vertical line to divide this and have a horizontal line also coming up, like Jesus Christ's cross, like a cross. Now what is happening here? I have assets plus expenses being equal to capital plus revenue plus what? Liability. This makes the accounting equation what? Balanced. And these are also the elements of the financial statement. Assets, expenses, capital or equity, revenue, and then liability. Most of the time we refer to that as such. Now we can clearly see that on the left hand side per my projection here, you can see that on the left hand side we have what? Assets plus what? Expenses. So we have on the left hand side we are having what? Assets plus what? Expenses. And on the right hand side you're also having what? Revenue, capital, and then what? Liability. Now, left hand side we are having assets and what? Expenses. On the right hand we are having what? Capital, revenue, and liability. So that is telling us that all the items on the left hand side, on the left page, here we refer to them as what? Being on the debit what? Side. Being on the debit side. And all items on the right hand side are also called what? Item being on what? The credit what? Side. All things being equal. Credit what? Side. Credit. The credit side. And this is what we establish what we call what? The double entry principle. This is what establishes what we call what? The double entry principle, which serves as a basis for recording of what? Transactions. Recording of transactions. From the accounting equation back to the double entry what? Principle. So the double entry principle is saying that in support of the duality concept that we introduced at the beginning part of the discussion, it says that when it comes to recording of transactions, it must affect the books what? Twice. It must affect the books what? Twice. That means every transaction must affect the books twice. Must have what? A debit, and must also have what? A credit. Must have a debit and also have what? A credit. So that means that on the debit side, all things being equal, all assets and then expenses supposed to be on the debit side. All assets and expenses supposed to have what? A debit balance. That's why you see it on the left hand side there. And all capital, revenue, liability supposed to have what? A credit what? Balance. Supposed to be at the credit side. All things being equal. So note that for assets and expenses, all items that comes under assets and expenses should have a debit balance. All things being equal. And then all items that comes under capital, revenue, and liability also should have what? A credit balance, all things being equal. And that is what? The double entry principle. The double entry what? Principle. The double entry principles, or the principle. Others will call it what? The golden rule of accounting. It's from the basis of recording of what? Business transactions, which says that in every account must be affected, or every transaction must affect the books what? Twice. Having the debit side and having what? The credit what? Side. So note that all assets and expenses is having what? The debit balance, and will always be on the left hand side of what? The account. This is also what we call what? The T account. We call this the T account. We call this a T what? Account. We call it the T account. So let's take note of that, the T account. Then we have assets plus expenses on the debit side, and we have capital, revenue, and liabilities on the credit side as well. Hence the double entry principle. So from the accounting equation back to the double entry principle. So that is the idea here you want to build up. And remember too that with the accounting equation then form the basis of what we call what? The financial statement, called the statement of the financial position. Because on the statement of the financial position, where we are having items of assets and expense, especially expense like prepaid expenses, will be captured as part of the assets on the current asset. You see them here. An aspect like capital, revenue, liability, all also can also be captured on the the statement of the financial position. Right? You can also capture them there as well. So this also forms the basis of the statement of the financial position, where we have assets being equal to capital plus liability, or assets being equal to equity plus liability. This also forms the basis of the preparation of the statement of the financial position, also called the balance sheet. So that is the idea from the accounting equation back to the double entry. And this is where we'll end our discussion on the accounting equation. So in our next section, we are going to discuss the double entry principles proper by looking out for the various books that are used in recording transactions, talk about the various types of accounts you're supposed to have in the books of accounts, and then even go a bit further to record some transactions, engage in balancing of account, preparation of the trial balance, and then we jump to also prepare other financial statement preparation. So thank you for watching this video. If you find this video amazing and helpful, do want to drop a like, comment, and share. If you're a new member here, thank you for joining us as always. This is a community of learners where we learn every day on mathematics, accounting, and then business issues. So thank you so much, and I'll see you in the next section. Bye.